Hi, I'm James Robinson, and this is my stock thought of the week. Today we're going to do part 4 on my series in value investing theory. What we're going to talk about today is financial statements. There are a series of financial statements that companies put out that will tell you a lot about what's going on with the company. And when you take those statements and a series of those statements over time, you can start to learn an awful lot about what's going on. It's the kind of thing that allows you to consider yourself someone who analyzes a company versus someone who speculates on one. Once you understand what's going on in the company, you'll understand a lot more about why you may or may not want to buy that company or buy that stock. So today what we're going to talk about is the most important, I think, of the statements, and that's the income statement. And we're going to go over the basics of what that is, what the components are, how it's laid out, and some of the things you can learn from an income statement. So the very first concept that you have to understand if you're going to start analyzing companies is that the language of business is math. Math is really important. We use math all the time in business to figure out what's going on and to understand what's going on and to understand how we can do things better or where we're making mistakes. It's important to note that none of the math is hard. You know, those of you who are not people who are really good at math or who get math intuitively might sort of be cringing when I say this, but I promise all of the math is easy. For the most part, it's addition and subtraction. There's a little bit of multiplication. There's certainly no very higher math. It's something you will all be able to grasp. Again, it's multiplication, subtraction, addition, some division, nothing that's very hard. And what I'm going to do as I go through this is I'm going to explain to you what's happening with math and why it's happening. And once you understand that, then you don't have to do the math yourself. Almost all of these ratios that we're going to utilize are available on the internet if you learn where to look, and we'll talk about that later. But for now, I just want you to get a sense that there is some basic math and that we're going to be talking about math and we're going to be talking about numbers, but we're going to do it in a way that hopefully won't be hard for those of you who don't love math and don't get it intuitively. So a college level class would be, in America, would be a 100 level class, would be a first year college student's math class, or class in any subject. And a 200 level class would be a sophomore, second year college student's class. And a 400 level class would be a senior, ready to graduate level class, kind of the highest class that's offered in pursuit of a bachelor's degree. So what I want you to think about this, that what we're talking about today is this is an accounting 50 class. It's not really a first year college class in accounting. I don't have a degree in accounting. I'm not a CPA. I'm not a college professor, and I'm certainly not qualified to teach accounting at that level. Having said that, accounting isn't really that hard, and a lot of the concepts we're going to talk about in these next few slides aren't going to be beyond anybody. And so we're just going to understand some fundamentals, but understand that you could go significantly deeper than this and spend a lot of time trying to understand this. And you still wouldn't be qualified as a professional. And a CPA is an extremely qualified professional who really understands this on an intuitive level. We don't have to get there to be an investor. Warren Buffett is not a CPA. Mohnish Pabrai is not a CPA. And Charlie Munger and all the rest, those guys aren't CPAs. You don't have to get that deep. But you do have to have some basic fundamental understanding, and that's why I'm calling this an accounting 50 level class. It's kind of halfway between what you learn in high school and what you learn maybe in your first year of college. And I did take some accounting classes in college, so I do have some understanding of this stuff. So this is not meant to be an accounting class. It's just a basic primer that we can ensure that we're speaking the same language going forward. It's an oversimplification, and I think the basic knowledge will stand us in good stead for developing and understand the basics of value investing. That's why I'm going to be teaching these next 3 videos, one of which is going to be on the income statement, the next one is on the balance sheet, and the fourth one on statement of cash flows, which are the fundamental pieces of information that we will use to analyze companies. So financial statements themselves are documents that are designed to quickly educate an owner or investor about the viability or profitability of the company. So long story short, it's boiling down all of the operations of the company into a format that's standardized, that's understandable, and that you can very quickly get a sense for what's going on. There are tools that are used for management to measure productivity and measure profitability. So a company can look at its various income statements and balance sheets and these various financial statements and start to get a sense for what's going on. And we're going to talk about the most fundamental and basic level of these sheets, but there's obviously significantly deeper and more in-depth versions of these that really can tell what's exactly happening with general administrative costs, for example, and that can be broken down into many, many more components. We're going to cover today the most grossly fundamental of those things, but they can be broken down much more simply, or much more granularly. Finally, it's a way to measure risk and the value of the company. That's more for the value for the balance sheet than it is for the profit and loss, the income statement we're going to talk about today. So today's lesson is the income statement, which is a clearinghouse for all operational financial data for the firm. In other words, it's a look at what's happening over some period of time with the company. It's a listing of all income and expenses for some period of time, typically a month, a quarter, or a year. And that's an important concept to understand. A income statement is not a measure of what happened at a specific moment. It's a measure of what happened over a specific time. So over the month of August, how much sales did we have? What were our expenses? Or over the first quarter, or annually, what were these expenses? An income statement always covers a period of time. And that's the opposite of a balance sheet, which is always a snapshot. It's an exact second of time. Typically, at the close of business on a specific day, the balance sheet will reflect what's happening to that company that day. And we'll talk more why that is later, but just understand for now that the balance sheet it happens at a specific second, and an income statement happens over a certain period of time. And that, again, with an income statement, all the financial is organized into recognizable categories. Those categories are typically standardized, so people know that, hey, this kind of expense always goes in this category, and that's called General Accepted Accounting Principles, or GAAP, or sometimes called GAAP. And that's the manner in which CPAs agree to do things. So in terms of components and structure, income statements always follow the same pattern. I say always, I need to backtrack. There's a couple of different kinds of income statements. There's income statements for operational companies, slightly modified for manufacturing companies, slightly modified types of accounting for service companies. And then there's dramatically different income statements for banks and for insurance companies. We're not going to talk about those for now. That's a whole nother can of worms. We're going to talk about basically service companies, and we're going to talk about service companies and manufacturing companies, because that's most of the companies that I invest in. So the standard format is revenues, which is the top line. And oftentimes you'll hear that. Top line improved for the company by X. What they're saying is that the revenues have increased. We're going to talk about the definitions for all of these things later. From revenue, you subtract from revenue the cost of goods sold. That gives you the gross profit, or sometimes the gross loss, hopefully not. From that, you subtract operating expenses, which includes R&D, selling, administrative, depreciation, a number of other things. That gives you your operating income. Then you have all other income and expenses. Then you have investment income. Then you subtract interest expense. You subtract taxes. You add in non-recurring events, which are extraordinary items which don't happen typically quarter after quarter or period after period. And then the final thing, the bottom line, which you'll often hear people talk about the bottom line. The bottom line of the income statement is the profit or net income for the company. So some clarifications for these definitions before we go forward, because people will get caught up and confused by some of these things, especially if English isn't your native language. For the purposes of accounting and for the purposes of what we're talking about, income and profit are the same thing. They're used interchangeably. So an income statement and a profit and loss are the same thing, and they're used interchangeably. And a company's income for a period of time and its profit for a period of time are the exact same thing. So whenever you see income or profit, those two words mean the same thing. So the first line on the income statement, the top line, if you will, and you'll often again hear things called the top line. What they're talking about is revenue. So revenue is income that is earned from the principal activities of an entity. So it's all of the money that comes in from doing what that company does. So if a company is an airline, then ticket sales, for example, will be revenue, and that will be income to the company. And that principal activity of the airline is transporting people, so of course that would qualify. In the case of a manufacturer of electronic appliances, revenue will comprise the sales of the electronic appliance businesses. If the same manufacturer earns interest on its bank account, that's not classified as revenue, but that's other income, right? Because their primary focus is not collecting interest, their primary focus is making electronics. So that's the definition of revenue, at least that's the simplified definition of revenue. The next category is cost of goods sold. Cost of goods sold represents the costs of goods sold or services rendered during an accounting period. So I hate it when someone uses the definition, the phrase of the words as the definition, but in this case, it really is accurate. So if you were when you say cost of goods sold, if you're selling jeans, right? Well, then the cost to produce the jeans are the cost of goods sold. So it'll be the denim, it would be the manufacturing costs. For a retailer, it would be the cost of sales would be the sum of the inventory at the start of the period and purchases during the period, minus any closing inventory. So that would be the total amount of inventory that was utilized during that process. In the case of a manufacturer, the cost of sales will also include production costs incurred in the manufacturing of goods during the period, such as the cost for labor, material, consumption, depreciation of plant and machinery and factory overhead, etc. So in manufacturing, there's a lot of things. It's the raw materials plus whatever is needed to turn raw materials into finished products. That's the cost of goods sold. So you'll have the revenue, which is the total amount of money that comes in. Then you have the costs to take the raw materials and create them into the product that was sold. And then what you have left is your gross profit. So total amount of money that comes in minus the cost of goods sold equals your gross profit. And gross profit is the difference between the revenues received for the product less the cost of goods sold. We're going to talk a lot about this number and these interrelationships between these three items because this is a really important measure. We want to know what the gross profit is relative to sales because it can tell us an awful lot. And we're going to talk ad nauseum about this going forward. But understand that this is one of the examples of things we can really glean by studying it, by studying balance sheets. Long story short, the revenues, the percentage that gross profit is of revenues is also margins. And if you followed me for a long time, you know that I really think margins are very, very important, gross margins. And so I want to know what those gross margins are because they tell me a lot about the company. And that's how this number is derived. After we figured out the gross profit, then we take out the operating expenses. So operating expenses are the amount an entity expends to maintain and operate the general business. Operating expenses include research and development, marketing, general administrative, amortization of intangible assets, for example, patents, goodwill, etc. In addition, when an entity purchases a capital asset such as a building or equipment, they expense a portion of the asset over a number of years. This is called depreciation. Depreciation expense is an accounting expense that is deducted from the net income. So let me break that down a little more simply. Cost of goods sold is the costs and the expenses related to the actual manufacturing of the product. There are, however, a bunch of things that a company needs to spend money on that isn't directly related to the product. For example, they have to pay a salesman to go out and sell the product. Well, that's a general administrative cost generally, or a marketing expense. In either case, it's not really related to the cost to make the product, it's just a cost involved in running the business. So marketing is another example of that. Research and development. These are things that we're spending on to make the business viable, but it's not directly related to the cost of the products that are sold. So we want to know what those costs are, and that's called operating expenses. When you take the gross income or gross profit and you subtract the operating expenses, you get the operating income. So it's equal to the revenues minus the cost of goods sold and the operating expenses. So it measures the profits or losses of the day-to-day operations of the business. Another name for operating income, which by the way is operating profit. Another name is earnings before interest and taxes, which is called EBIT, E-B-I-T. I never use that term, but a lot of people do, especially a lot of investors. I'll get into in other videos why I don't use EBIT as a term. I don't use EBITDA, which is a further expanded definition here. But a lot of people do, and if you hear that term, you'll get a sense of where that comes from. So then we have other things that are much, maybe not less important, but less obviously important. Other income and expenses. So to obtain net income, further adjustments must be made to account for interest income and expense, income tax expense, and other extraordinary and miscellaneous items. So those items are kind of added as sort of an afterthought at the end. By the way, we paid some interest expense, we had some interest income from money we had in our bank, we had to pay some taxes. Those kinds of things are added on at the very bottom. And the reason they're added on the bottom is because they're not strictly speaking operational. They are more related to the situation of the company, the tax situation that you're in, but they're not directly related to the operation of the company, and therefore for most investors, they're not as important. Some of these things are derived. Income tax theoretically is simply derived. You made a certain amount of money, you're going to pay a certain amount of tax. Doesn't matter how good a company you are, doesn't matter how well managed you are. If you make a certain amount of money, you're going to pay a certain amount of tax. That's an example of why it's more considered very late in the income statement and not as thoroughly analyzed, if you will. So the final item is profits or net profits. That's revenue minus all expenses equals the net income, which is also another term for net profit and loss. Profits are also referred to as net income or the bottom line. You'll see when you look back at the slide, you'll see that the very last thing to talk about is on the income statement is the net profit. That's why it's called the bottom line. Because all profits are reported at the bottom of the income statement. Some analysts call these accounting profits because they include non-cash accounting entries such as depreciation and amortization. We'll talk more and more about depreciation and amortization later and what they mean and why they're not, strictly speaking, the same kinds of expenses as, for example, marketing. But for now, we don't really need to worry about that. It's getting more into minutia. But that's basically what the profits are. The profits are total revenues minus all expenses. That comes up with your net income for the company. So another set of clarifications. There are three kinds of profits. And again, profits are interchangeable with income. So there's three kinds of profits. The first one is gross profit, the second one is operating profit, and the third one is net profit. So I'll break them down for you. Gross profit is the revenues minus the cost of goods sold, right? So gross is, the shorthand I use is gross is the least sexy, right? Something is gross, it's ugly, it's the least sexy, it's the number we care about the least, because there's still a whole bunch of work to be done before anything turns into profit. Operating profit, I look at as sort of the down and dirty middle ground. We're still working on things. We're not completely done. We're halfway done. We're operating on it. And then the final way that I use for shorthand is the net profit, which is the bottom line, money you get to take to the bank. I just kind of envision that you're standing there with a net and the money falls into the net. That's your profit, and you get to take that net home with you. It's like when you fish. So that's the way I look at it. That because people get confused with these things, say, what's the difference between gross profit, operating profit, and net profit? That's the way to think about it. The gross is it's the ugliest, it's the least important, it is the least amount of data associated with it. Operating, things are still in process. We haven't really gotten to the bottom line yet. We don't exactly know what we made. And net profit is all the money that falls into the net we get to take to the bank. That's the way I keep those three straight, and hopefully that'll help you to do the same thing. So why have I shared this? Why have I taken time to go over this? First of all, if you're an accountant or a guy who gets business and does a lot of business, you may understand all these things. But I would suspect that a significant number of the people who follow me really don't spend a lot of time on this and maybe don't have a sense of where to start in terms of looking at a company and trying to do their own research on companies. And one of the things that I want to do is I want to get everybody to the point where they're all doing great research and they're telling me stocks to look at, so I don't have to do all this research myself. But more fundamentally, making investments as a value investor starts with understanding the value of the company. And if you're going to understand the value of the company, you have to understand its profits and how they're derived. You have to get a sense for what exactly is happening with the company. You have to understand what the company's expenses are, and you have to understand how those expenses measure up in the scheme of things. It's not just what do they spend. You can ascertain an awful lot about a company by understanding the company's gross revenues and their cost of goods sold and what they're spending on R&D relative to other companies in their industry and relative to other companies in general. So there's a tremendous amount of information that can be gleaned from understanding financial statements, and especially comparing this company's financial statements to other companies, either in the same industry or in general. And then once you understand these, then you'll start to understand that there's a series of ratios and analysis that can be derived from these statements. And those ratios can also be very, very telling. So, what's your return on investment for marketing dollars, right? If a company is doing a poor job of marketing or a good job of marketing, you want to know that. And if you understand if you understand financial statements, you can understand how to figure that out for yourself. So in future discussions, I'll discuss some of these ratios and what they mean and why they're so important. But I don't think any of the things that I'm going to talk about going forward as we understand how to invest companies make sense if you don't understand the fundamentals of these balance sheets and the income statements and the cost and the cash flow statements. So that's why I've spent so much time on it. That's why I'm going to spend time in the next couple of videos on the other significant financial statements. So I thank you very much for your time. If you like this, please subscribe. Please hit the like button like everybody else says. If you want to follow me on Twitter, where you'll see real-time information on when I make trades, where I'll post articles that I think are interesting, my Twitter handle is @RobinsonStocks. Again, thank you very much for your time, and I'll talk to you soon.